Hi, and welcome to this weekend's weekend macro call hosted by myself, Adam Crook, with a couple of pieces recorded earlier by my partner in banking, Leah Larson. After a tremendously busy week in markets, we pulled together what we hope you'll find is a very insightful lineup of speakers to help our clients make sense of the announcements and whirlwind of moves in markets over the last few days, and help them also to tread a path from here. We're going to start today with Steve Pastrick. Steve works in our Office of Government Affairs in Washington. We hosted Alec Phillips on a webcast called Tariffs, First Thoughts on Thursday. That's still available to listen to on replay. So this part from Steve really should be thought of as complementary to Alec's views. Please do listen to both to form a view, from the Goldman Sachs side. Jan Hatzius then joins us to help distill how to think about last week's historic announcements in terms of the impact on the US and global economy. Don Wilson follows with some very timely thoughts on what markets are pricing in terms of growth outcomes and upside and downside market scenarios from here. We then have Tony Kim, co-head of commodity trading in EMEA, on what this means for gold and energy prices from here. Jari Stehn talks us through the potential growth impact on Europe, the ECB, and how he thinks Europe might respond. And finally, Ben Snider with a preview of upcoming earnings season and how to think about the US equity market amidst this policy and economic volatility. As always, just like to remind clients that this call is for GS clients only. If there are any members of the press or non-GS clients on the line, then please do hang up now. Okay, with that, I'm going to hand over to Leah Larson, who, as I mentioned before, is a partner in investment banking.
Thanks, Adam. Just a reminder, I'm on the private side of the firm. I won't be sharing any MNPI, and I am not soliciting or recommending that any investors take any action. Also note that the views expressed by my guests are theirs and not the views of investment banking. And with that, I'd like to welcome Steve Pastrick onto the call. He's one of our senior advisors in our global affairs group in DC. Steve, let's just start with it. What are your takeaways from the tariff announcements on Wednesday night?
Sure. Thank you, Leah. So, look, I think that the numbers that came out, I think people are a bit surprised, number one, at the amount of tariffs imposed. And I think they were also caught off guard a little bit by the tiered, I guess you call it the tiered system. The headlines came out about 4 o'clock this week about the 10% baseline tariff imposed on these countries. And I think that led people to think that they're going to be more lenient after perhaps a week or two of the Trump administration sort of having mixed messaging around leniency and other views on tariff policy, but it came out with that 10% at 4 o'clock, thinking that it'd be more lenient. Then, of course, in the press conference, there was just this waterfall of increased tariff rates on the EU, on China, and other countries. So I think that people were a bit caught off guard, both at the, let's call it the complexity, the differentiation between the countries and our trading partners, and also the tiered system. I would say that there was this expectation, though, that there would be a focus on, obviously, our core trading partners, but the dirty 15, as Trump had labeled them earlier in the week. And the number came out, I think, around, obviously north of 15% in terms of the average there. But it came out in terms of what Peter Navarro, the White House trade counselor, had been talking about in terms of the revenue expectation around, I think he said, $600 billion per year or $6 trillion over 10 years. And so if that, that number was released the week before, sort of floated the weekend before. And so with that, it sort of fell in line with some of the rhetoric on the Trump side. And, at the same time, it came in at a bit of a higher rate than people had expected at that point.
Thanks, Steve. So where do you think we go from here? And I mean, related to that, do you think that Trump's initial rates were where he wants to end up? Or is this just initial posturing and we expect him to negotiate to a different level?
Yeah, I think the administration has been very forward-leaning in terms of calling this the America First trade policy. And throughout the messaging this week from the administration, they've been very adamant that this is what should have been expected coming into this administration, right? The view had been that they had not used tariffs to maximum effect in Trump 1. And I think they're telling people that, look, we are very willing to use tariffs and keep them in place for some time at this point. However, right, that was the Wednesday messaging. I think we've seen a little bit of I wouldn't say a fracturing, but differentiation between what some people have said in the administration in terms of their willingness to negotiate, right? I think Trump has been floating the idea that, of course, he's willing to negotiate and bring the different parties in here to talk about what's the best offer, make the best deal, talk to us about how these tariffs can be lowered or come down. At the same time, I think others have had a harder stance saying, like, we're willing to endure more pain as long as this is sort of our trade policy, and this is what we're aiming to, right? The goal of all this, of course, at a high level is to restart U.S. manufacturing and sort of encourage people to produce here. And that's sort of the crux of America First trade policy. I think in terms of are we at peak uncertainty or are we sort of past that point, it does feel like there are two routes that countries have taken so far. One has been retaliation. Of course, we saw China retaliate. And the other is sort of a quiet conversation with the administration about what kind of offer or what kind of deals can be made in an effort to really reduce this, whatever rate is applied to whatever country is having this conversation. So, I think we're, for the time being, for the short-term period at least, we're going to stay at this number. I know the administration has sort of threatened to have higher tariffs if others retaliate on the U.S. tariffs. But I do think it's going to spur conversations, and you're going to see a number of delegations come into Washington and try to have this conversation about bringing these down. And look, we have till April 9th for some of these tariffs to actually take effect. I don't foresee this massive rollback if they give themselves a week to do this. At the same time, it does give them a little bit of wiggle room to have a conversation with certain countries. So I don't think this is going to be like we saw in the playbook of Trump 1, where it was announced and then roll back and have a conversation and have that preempt the implementation date. But I do think they gave themselves a little bit of time to have maybe some conversations. I'm not predicting this broader effort to roll this back, but I do think there's a little bit of wiggle room, and I think you'll start to see a lot of people coming to town in the next week or two and have these conversations go forward from there.
Thanks, Steve. Last question for you. We obviously saw China retaliate yesterday. Do you think that the administration expected that level of retaliation?
I would say, look, China's been very measured in the response to tariffs over the past, Trump 1 and Trump 2, right? They've basically matched what the U.S. has done in terms of their response to U.S. policy. And I think we've seen that they have been so measured that at some point they had to continue to be public and respond to the U.S. action. So I think the administration expected it. I think it's a prelude to more conversations with China, not only on trade, not only on investment, but a broader, let's call it a phase 2 deal that has been sort of floated about for many months. And of course, Trump has signaled his openness to having a broader conversation with China on a range of issues, including, of course, TikTok, right? So look, I think that was expected. It's in line with what they've done in the past. And this is just going to start a broader conversation. I don't think it's going to be immediate with China. I think it'll take some time, but it will spur more conversations going forward.
Thanks. And we now have Jan Hatzius joining us. Jan's obviously our chief economist and probably nobody better to help us guide us through, the economic backdrop at the moment. Just for full transparency, Jan and I are recording this just before the close in London, so just before 5 p.m. London time, 12 p.m. Eastern Standard on Friday. Jan, let's keep this very simple. First of all, February job numbers, do they matter?
No, they don't matter. It's ironic that they showed stronger than expected employment and somewhat lower than expected inflation pressure through the wage numbers at a time when we're probably on the cusp of a period of stagflation, or at least a sizable increase in inflation and significantly weaker growth at a minimum.
Great, thanks, Jan. And obviously at the start of last weekend, actually, you took your recession odds higher. How worried are you about recession now?
I mean, we're pretty worried. Last weekend, before the announcements on tariffs this week, we cut growth to 1% on a Q4 to Q4 basis. We raised the core PCE forecast to 3.5% year on year later this year. And we raised the recession probability over the next 12 months from 20% to 35%. That was with an assumption that the average U.S. tariff rate in 2025 would increase by 15 percentage points. What we got on Wednesday, assuming this is it, and we still get some additional product-specific tariffs on things like pharmaceuticals and semiconductors, which we have been assuming, but otherwise, in terms of reciprocal and broad tariffs, this is it. This gives us 19 percentage points. So 4 percentage points more than what we had expected. Our estimate is that each percentage point is worth about 10 basis points on core PCE, and it's also about 10 basis points off of growth. And so if you just mechanically applied this without looking at anything else, you would say, you're adding maybe 0.4 of a percentage point to inflation, so that gets you closer to 4, and you subtract another 0.4 or so from growth, so that gets you somewhere to the mid ones, and it's moving in that direction. I mean, I would say this means it's 35% and rising on recession risk, and also I would note that these calculations make some reasonably conservative assumptions on the growth side about financial conditions effects and uncertainty effects. These are hard to measure, they're hard to predict, and so we're on the conservative side there. So if we see continued tightening in financial conditions, that's going to mean additional recession risk. So we don't have a recession in the forecast, but we're definitely getting closer.
Thanks, Jan. And finally, the Fed. What's the view on the Fed from here?
Our baseline forecast, again, with this latest shift, is 3 consecutive insurance cuts of 25 basis points each in July, September, and November of this year. But the risks to this are tilted to the downside. Doesn't mean we couldn't get a scenario where nothing happens. I mean, that's also possible. If inflation is high and growth somehow holds up a little bit better, we could get nothing. But if I look at the probability weighted distribution, the risks are much more tilted to the downside, because the funds rate at the moment is still 4.25% to 4.5%. So if we did go into a recession, we would get a lot of cuts. And therefore, if I look at the probability weighted version of our forecast, we are still probably a little bit below market pricing at this point. And, I think there's a reasonable debate about what has to happen to get you cuts in June, which is obviously fully priced in the market at the moment, or even in May. We're not forecasting that, but the market is, pricing something a little bit less than 50% of a 25 basis point cut, and a little less than 25% of a 50 basis point cut as we record this. And that to me still seems pretty modest, because it's certainly possible that, things continue to get worse over the next few weeks. We get another employment report on the Friday just before the May FOMC meeting. And if that is bad, you certainly could get a cut at the May meeting, and they could very well start with a bigger move, given that the funds rate is still so high. So a lot can happen. It's a very uncertain environment, but I do think that if the labor market deteriorates, then my expectation would be that the Fed is going to cut pretty quickly, even in an environment in which inflation pressure continues and we continue to get these supply side tariff shocks.
Great, Jan, thank you. And our next speaker, Dom Wilson, Senior Macro Advisor. Dom, thank you as always for joining. First question to you. Given the scale and breadth of the tariffs announced on Wednesday night, how do you view their impact from a cross-asset perspective? Where do you think opportunities and risks present themselves from here?
Yeah, obviously, it's been a tricky and turbulent period over these last few days. We've been worrying for a while that US growth expectations have been vulnerable to downgrades. And Alex's view coming into this was that, tariffs were likely to be on the higher end. So you've been kind of thinking that the downside risks in equities and bond yields were being underpriced. In the end, the outcomes that we saw on Wednesday were even more hawkish than Alex had kind of signaled. We're obviously still waiting to see where it all ends up. once any further measures, retaliation, renegotiation is over. But I think, there's still kind of two-sided risk around that. China's countermeasures came quite quickly. We're still waiting to see what Europe and some others do. If you look at what's happened, market's effectively done another large downgrade to US growth views. If you look just on Thursday alone, the tools that Vicky has for looking at growth and policy shocks suggest moves in equities and bonds were equivalent to a more than 60 basis point move in the 1 year ahead GDP growth view for the US that the market's embedding. That would be the biggest one-day move in that measure since June 2020. Friday's continuing those moves. Not sure where we'll shake out yet, but continuing in the same direction. And there are bits of the market, cyclical defensive equity baskets, for instance, that saw even larger moves, largest moves in the last 20 years for any single day. So, we've moved a long way from the cyclical optimism we saw coming into the year. We've obviously put a much bigger weight on recessionary cases than before. But although those changes have been big, I think it's still harder to find, uniformly places across assets where the levels that we're looking at, are pricing a full recession. We're pricing much higher levels of equity volatility. We're pricing a decent amount more Fed easing, than we were. But if you look at the kind of recession scare we had last August, even, we had a lower trough in rates and more Fed easing priced at that time. And when you look at things like high yield credit that have also moved a lot, they're also not at levels that I would think of as kind of purely recessionary levels at this point. It's, it's a moving target. I think unless there's a shift in the policy stance, we're likely to go firmly on recession watch in the US for the next month or two, particularly because some of the soft data, consumer sentiment, parts of the services surveys are already heading in directions that are often consistent with recession. Obviously, over time, if we don't get as much follow through in the data on the downside, you could get some scope for some relief from this pricing. But I think the best chance of that relief really comes if there's some policy reversal. In the meantime, I think any signs of weakness in that period in the data are going to come in a context where the market has still got room to raise that recession worry further. Usually, I would say positioning for lower US rates, probably the simplest expression of that view. And I do think even after this pretty big rally, that's probably still right. I think balance of risk still points to equity downside here too, but it is important to watch for any signs of a pivot from either the administration or the Fed. I think once these kinds of crises get going, it's always good to start going through the conditions you would want to see for that kind of downdraft to end and risk recovery to begin. I don't see them yet. Like I said, I think our general view is more cautious and more defensive than that, but I think it's good to start kind of thinking about what those conditions would look like. As we said, also going into this, I think you need to be careful about assets that have relied on a strong form of kind of decoupling. We've had non-US outperformance so far this year, so positioning is built up in places that will be more vulnerable if we get continued downside pressure on US assets and on the US growth rate. You've seen already pretty sharp unwind in Japanese rates the last few days. You've seen European banks start to come into focus. Some of these areas that have been resilient over the course of the last few months, are now succumbing to that pressure. And I do think the risk is, when you have this big risk reduction, you start hitting the winners in portfolios too. I think those are areas to look for kind of in the medium term for opportunities again, but I would be careful relying on that here. So, we're still more in the camp of kind of going with the moves on the downside here and worrying more about kind of recession risk. As that pricing improves, we're going to start to think about the possibility of upside, but it feels early to be leaning in that direction.
Thanks, Dom. A second question. How do you think investors might alter their positioning in US assets going forward in response to Wednesday's tariffs?
Yeah, this is becoming a much more prominent question that we're getting from investors. We've been observing already that the reaction to tariffs has been changing through time. Last year, early this year, the asset market reactions to tariff risks was pretty consistent. You saw dollar strength. You saw US yields generally going up a little bit, and US equities went down but outperformed non-US equities. So that was kind of consistent with the idea that tariffs would be a modest drag for the US and a bigger risk for other people. You've seen that start to shift already over the last month or so towards a story in which tariff announcements have created more downside to US equities. They've pushed yields in the US more clearly lower, and they've led to a weaker, not a stronger dollar. And this week we saw an even sharper version of that with the dollar rallying sharply on the back of the announcements. I think there are two things going on. The first is that worries about US growth have been increasing, and the view that tariffs may create a kind of unique uncertainty shock for US businesses and consumers that raises the risk of bad growth outcomes here in the US. Also, more focus on the potential for retaliation. Those things have come more sharply into focus. So what we're seeing is that even those sort of tariffs you would think of as sort of dollar supportive, they're trading more like a classic US growth shock, yields down, dollar down, equities down. And in dollar terms, Europe, Japan, China, have outperformed, somewhat over this recent period. The second thing, which relates to that, but is more directly focused on your question, is that there's now more worry that the shift in policy that we're seeing in the US just going to lead to more nervousness amongst international investors about the deep overweight that they've, accumulated in, what are still quite appreciated US assets. That's mostly about the concern that overseas investors are expressing, both about uncertainty and the policy framework in the US, and worries that we will see people start to shift more persistently to reduce their exposure to US assets. I think of those two dynamics, the first is easier to handicap. I do think we're going to find that there is a lot of focus on US growth risks and recession risks in the next couple of months. And, as we just talked about, there's definitely a downside case there that is leading, investors to question their exposures just on that basis. And if we keep trading risks like a conventional US growth problem where dollar is weaker and equities are lower, that's a very, painful place for unhedged, overseas investors in US equities. So I think we're definitely still vulnerable to that dynamic unless recession fears can be put to rest. I think the second issue, this sort of bigger issue about a kind of broader pullback from US assets, is harder to gauge. It's definitely a much larger part of investor conversations. And since a lot of those investors are the ones who will drive the notion of whether there's a bigger shift in people's willingness to hold US assets, there's some kind of self-fulfilling element to that. I do find myself lately thinking more about 2002 and the turn in the dollar there, and in US outperformance there. Like a lot of things in FX, it's hard to be confident you really understand what's going on. But at a high level, I think you saw both some of the kind of cyclical derating that we've been seeing. The market hoped for a speedy recovery from the 2001 recession and equity rout, and then I think in early 2002, saw that it was going to take quite a lot longer, even as some other kind of parts of the world stabilized. But I would say you can also argue that the long bursting of the US bubble and then the kind of corporate scandals that we saw in 2002 played a role eventually in making investors just rethink their allocations kind of more structurally and their willingness to send capital to the US. I think it's harder to be confident for me, that that's definitely what's happening or what we're going to see. But I do think it's clearly a more meaningful risk, and I understand why people are considering that as a serious possibility. Just the question of whether we'll have kind of a shock to the capital account in the US that leads people to kind of pull back their exposures in a more persistent way. One thing I do think is that if we do go there, the main adjustment mechanism, I think, is usually through the currency and potentially through equities to some degree. There are often stories about, how that might be very disruptive for the US Treasury market and some of those kind of fears of a kind of UK style, 2023 episode where yields are up and the currency is down. I think those stories are usually given too much weight. Maybe in that scenario you get some pressure for curve steepening and a bit of term premium impact, but it's striking, we're seeing very clearly yields falling, not rising in the US. And I think the real risks are to the value of kind of US real assets, so the mix of equities and FX, if you get that kind of pullback in people's willingness to allocate. So, it's something we're watching and thinking about, and I think it is, becoming a much more interesting part of the distribution.
Great. For our next section, we're going to bring in Tony Kim. As mentioned before, Tony is Global Head of Metals Trading, co-head of EMEA commodities trading. Tony, let's talk a little bit about precious metals to start. Very big, some would say at times slightly counterintuitive moves in gold at the end of last week, despite heightened trade tension and a weaker dollar. How do you explain that, and what factors do you see driving precious metal prices from here?
Yeah, sure. So, look, I think given the macro setup, everybody's scratching their heads in terms of why gold actually liquidated in the second half of the week after the tariff announcement. And I guess I would just maybe point back to a few instances that were maybe the demarcation points of prior bull markets in gold. The first one being during the GFC, post-Lehman in 2008, whether you're looking at COVID or Russia, Ukraine, usually the first move is lower. And I think it's a bit counterintuitive, but the way I would just describe it is clients at this moment, because of the exceptional vol in markets, are just degrossing their portfolios. And if you asked any institutional investor over the last quarter or even the last year, everybody was either bullish or very bullish. And so the degrossing really just means a liquidation of the position that they currently have on. And I think the big question mark for us is, how long does that go? I think the challenge is it's been such a universally popular trade for so long, depending on how risk sentiment goes and how retaliatory tariffs come out, the positioning cleanse is going to dominate maybe the more fundamental thesis behind gold. But taking a big step back, look, this is probably a very constructive setup for gold. People always question, what is gold a hedge against? Is it a risk off? Is it higher inflation? I think the scenario where gold tends to perform the best would be a stagflationary environment where you do have weak growth. You're concerned about a recession, but inflation remains stubbornly high. And the probability of that outcome playing out today versus 1 week ago is probably materially higher. So I think once the dust settles, this is going to be a structural trade that potentially shows up again. The other driver of the trade has been de-dollarization. And I think if you, again, look at what's happening around the world, given the unpredictability of U.S. policy at the moment, if you had to think whether reserve managers are going to accelerate or decelerate their de-dollarization of reserves, both at a central bank level, as well as an institutional and retail level, I think if anything, that's going to be in higher gear. So, we're going to be looking for signs of an exhaustion in the liquidation for gold. And I think early days, you're probably going to want to deploy via option structures because it's going to be very hard to have the conviction that the positioning has cleaned up. And I think as the market stabilizes and maybe finds some technical support, converting some of that optionalized length into delta length is going to be the way to go. Hard to say at this point, but I think in the next week or so, we're probably going to get to a point where you're going to want to consider potentially adding into gold length, depending on how the market positioning stacks up.
Thanks, Tony. Let's talk a little bit about energy now, because huge moves in oil and nat gas prices as well. In many ways, I guess you can kind of understand that as the market, re-rates the demand outlook, given the growth downgrade. How are you thinking about the upside and downside risk to both from here?
Sure. I think, this really caught the energy complex, I think, by surprise, not because of what could happen with tariffs, but I think the magnitude of the macro shock, especially to forward growth projections, as well as, what's happening in the equity market. And so, the big move out after the tariff announcements was really in oil, where you saw, a $5 down move. It was really at the bottom of the range. And despite what we would say is a pretty strong physical market with tight inventories across the board, the market really sold off more than we expected. I guess said another way, if you told me that after the tariff announcement that oil would react, by some measures more than the equity markets, I think that would have caught a lot of folks off sides. But if I have to point to the reason for that, the announcements from OPEC Plus really kind of shocked the market. They unexpectedly announced an increase in oil supply by 3 times the amount that they had originally telegraphed. And I think that really concerned the market and spooked them, because until this point, the downside was really protected by OPEC policy, as well as, just the elasticity of supply out of U.S. shale. If OPEC's policy has really structurally changed, I think you've opened up, a new side of the distribution to the left-hand side. And I think, as the week kind of moved on and we started making new lows, that very quickly settled into a new vol regime. GIR has been calling for a range-bound market. I think they had many good reasons to have that view, and OPEC's policy was certainly part of that. If that policy is changing, combined with the potential shock in a slowdown in global demand, you could see a lot of volatility on the oil side of the ledger. And so, what we saw was day one, price lower, and then day two, vols really started to disconnect because of that potential regime change. On the gas front, in the US, it's been mainly, focusing a bit more on the local micros. But in Europe, it's certainly been, again, re-rating demand lower. And if this trade war does escalate with the EU retaliating, what does that mean for industrial activity, for demand out of the continent? And that was something that prior to this point was very positive, with the resurgence in the euro, with the fiscal package from Germany. And now I think we're taking all of that out and then potentially looking at weaker aggregate global demand. So I think the market response makes sense. And I think our next move is going to be driven probably more by where equity markets and the VIX are trading than necessarily counting barrels and looking at supply demand balances, which makes it a very challenging market to trade.
I'd now like to welcome Jari Stehn onto the call. Jari is our chief European economist. Jari, thanks for joining us. So first question for you, what are the implications of this week's announcement on reciprocal tariffs for growth across Europe? And importantly, how will European countries respond to this?
Yeah, we would say the announcement was generally towards larger tariffs globally. And so it reinforces our sense that this is going to be quite negative for growth across Europe. So if we start with the euro area, we got a 20% headline reciprocal tariff, which is larger than the 15 we had assumed. But once you take exemptions into account, in particular that these don't stack relative to existing targeted tariffs, you actually end up with a slightly smaller increase in the effective tariff rate than we had assumed. But I would say the fact that the tariffs were bigger globally and we've seen a meaningful tightening in financial conditions kind of leaves us comfortable with our forecast of a 0.7% hit to GDP from trade, and reinforces our sense that the economy will grow less than expected this year. So we have 0.8% growth for the euro area below consensus, and we see little growth in the second and third quarters. Now, on the retaliation point for the euro area, we think that the EU will retaliate in tariff value terms against the targeted tariffs, so essentially match the amount of tariff collection for the earlier rounds, but will only retaliate in tariff rate terms to the reciprocal tariffs. Now, that's important because it means that the EU will likely collect fewer tariffs from this than the US will only, we think, retaliate to about half of the imports from the US. But nonetheless, I think this is now one of the big questions, how the retaliation unfolds and whether the US again responds to that. And that's why we think the risks to the growth outlook for the euro area are further skewed to the downside because of the chance that you get another round of tariffs to the retaliation. I would also say that an important area to watch is services trade, where the EU actually has a deficit with the US. It has tools to affect services trade. We don't think this will be part of the initial response, but I do think this is something on the table, as well as, of course, possibility to commit to additional purchases of US goods. So I think the response here from the EU will have both a carrot and a stick component. Now, briefly on the other economies, in the UK, the reciprocal tariff announcement was clearly higher than we had expected, and the 10% seems quite sticky. As the US has said, this is the minimum baseline tariff. And of course, the UK is also pretty exposed to the weakness in the EU and in the US. And we, as a result of that, downgraded growth further this week. We now have 0.8% growth for this year, which is below consensus. We think the UK will be quite careful in its response, so we don't expect significant retaliation from the UK. There seems to be an attempt to find a broader agreement and to try to lower some of those tariffs. And then finally, in Switzerland, Sweden, Norway, we've also made further downgrades, partly because of the direct tariff announcement and also because of the indirect effects of weaker growth elsewhere. So bottom line to us on the growth front is we're below consensus across Europe, and I think there are further risks to the downside here.
Thanks, Jari. And then what do you think this does to European monetary policy?
I mean, at face value, it's not obvious because, pushes down growth and pushes up inflation. But we think the effects on inflation are small and, quite importantly, are temporary. They're really very mechanical. And so we think the net effects on monetary policy are dovish for the region. So if you take the ECB, we think a cut on the 17th of April is now highly likely. So not only do you have the tariff developments, but also the news on inflation has been soft. The exchange rate is appreciated. Energy prices have come down. And so we think a cut there now is very likely. And, a good chance that we'll get some signal from a senior governing council member before the blackout period starts. We then think the growth projections will have to be cut significantly in June, and that will come with another rate reduction. And then we have them following up with one more rate cuts in July to 1.75%. And given the growth discussion, we think the risk here is skewed towards lower rates if the trade war escalates. In the UK, we think the Bank of England will stick to the quarterly path of cuts because inflation is still too high for comfort. But we now think that the UK will continue to cut for longer. We added 25 basis points to the forecast. We now have them cutting to 3%. And we think there's a chance of them speeding up the pace of rate cuts along the way. So we would continue to look for more repricing there. And then elsewhere, we also have dovish views. So in Switzerland, we added a cut. We now have them going slightly negative by September. And then we also look for more cuts than is priced in both Sweden and Norway.
Thanks, Jari. Now I'd like to welcome Ben Snider onto the call, our senior strategist on the U.S. portfolio strategy macro team. Ben, first question for you. GS Research has been constructive on the equity market for the bulk of the last few years, but now are comfortably below consensus and certainly are more negative. What are the drivers of this view, and how do you see the outlook in the wake of Wednesday's announcements?
That's right. We did make pretty large revisions last week, and that was the second time reducing our view so far this year. And there's really been two key drivers of the view. The first is lower earnings expectations, and the second is lower multiples, more risk premium. On the earnings side, we're now forecasting 3% S&P 500 earnings growth this year, and that's quite a drop relative to the 11% expectation we had coming into this year. And for reference, consensus is still in the high single digits, call it around 9%. So our numbers are lower than we had them at the start of the year and also substantially below consensus. Then on top of that, the combination of weaker growth and much, much higher uncertainty means those earnings should trade at a lower multiple. And here too, we came into the year at roughly 22 times forward PE. We're now still roughly 19 times, and that is above the 10-year average, above the 30-year average, and well above the troughs of previous major market downturns. And so the view here is that the market needs to be pricing both a lower base case outlook for corporate profit growth and also more downside risk around that base case. And if you put aside the earnings and valuation framework and just think about this from the perspective of a trader, supply and demand, we've seen, of course, a 10% S&P correction pretty quickly this year. But if you look at who was selling during that correction, it was really mostly hedge funds and CTA, systematic investors. you've really seen so far very limited selling from the other major owners of the U.S. equity market, like households and mutual funds. And some high-frequency data suggest that's really just started in the past week. So still a lot more room to go. And then, of course, the question is, well, what's happened since Wednesday, because it's been such a volatile week? And I would say three key things have changed. First is, of course, the tariff announcements came out, and they were not dramatically worse than we expected, but they were worse than we expected. The second is some policy signaling from the administration that tells you the policy put is still deep out of the money. And then the third thing, of course, is also selling and lower prices. And so on net, even with those lower prices, we're our forecasts, our base case are less below the market than previously, but still, it looks like because the risks to our forecasts are skewed to the downside, risks to the market are skewed to the downside as well. And if you want to go further and ask about, the likelihood of recession, which has been a very, very popular topic of conversation with investors, just to benchmark, in a typical recession, the S&P falls by about 25%. That would put the market, call it in the mid 4,000s, still substantially below current trading levels. And likewise, if you look at the multiple in other major market downturns, recessionary, non-recessionary, that would be roughly around 15 times. As I mentioned earlier, we're still close to 18 or 19 times, meaning still a lot of room to go. So obviously things are moving very quickly, but at the moment to us, still looks like risks in the market are pretty clearly skewed to the downside.
Thanks, Ben. So next week is the start of the first quarter earnings season. What do you expect, and what are you watching out for?
Yes, no rest in a very busy market. Season will kick off this coming week with the big banks. The big tech stocks will report towards the end of the month, and then we'll have almost all the S&P reported by the first week of May. And I think this is especially important because this is a real glimpse into how trade policy and political uncertainty are affecting both corporate profits and corporate behavior. And of course, every earnings season is important for equity investors, but I think this one is particularly important, not just for equity investors, but for all market participants, because it is a key part of that potential feedback loop from trade policy on uncertainty to the real economy via business investment and CapEx and employment. And so, in terms of the actual results, if you just think about the 1Q earnings that will be reported themselves, you're not going to see much of the actual tariffs, but you will see modestly slower growth. And if you look at analyst estimates, you see that. Consensus is expecting just 6% earnings growth in the first quarter year over year. And to frame that a little bit, in the fourth quarter, growth was 15%, and expectations for the first quarter were also 15% or so coming into the year. So there's been a major reduction in the outlook for the first quarter. But what's amazing is revisions have not really affected the rest of the year earnings. And so there does seem to be a major disconnect today between what analysts are currently penciling in, what the market is thinking about, and of course, our forecast, as I mentioned earlier. And because you're not going to see much of that in the actual first quarter results, I think it's going to be really important to pay attention to company commentary and management guidance. And management guidance is always important. I think it's going to be particularly important this quarter. Unfortunately, I think you're also going to see a large number of companies pull their guidance just given the uncertainty. And so from our perspective, there's three key things we're going to be tracking throughout the season. You're going to hear us talking about this repeatedly that I think will be very good barometers for the forward-looking equity and macroeconomic outlook. The first is revenues, revenue guidance, revenue revisions, and that's really an indicator of how the health of the consumer and the consumer psyche is actually flowing through into realized demand. The second thing is CapEx. As I mentioned earlier, uncertainty should affect business investment. That is a major driver of the economic outlook, and we'll see how that is actually flowing through into corporate spending. And then the third is we'll be keeping a close eye on margin estimates. Margin estimates are really the huge downside risk to analyst numbers. If you look at analysts, they have S&P 500 profit margins climbing to a new record level by the middle of this year. In contrast, our estimates are effectively flat, and that's due just to negative operating leverage, slower growth, and of course the impact of tariffs. And so I don't think you'll see full capitulation this quarter. I think uncertainty will stay high, but I do think you'll start to see a decline. I think you'll start to see that downward revision process start. And unfortunately, I think we have some pretty negative earnings revisions ahead in store for us over the next few weeks.
Thanks, Ben. Thanks to all our speakers today, and thanks to our clients for joining. We'll be back next weekend with another GS Weekend Macro Call. We wish you all the best in these volatile markets. Thank you.